Hell is coming. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story that just leaked report exposes a devastating plan to crash the global economy. And you're not going to believe who is behind this report and why they want to see everything come crashing down, because as we're seeing it right now, and we're going to look at some data today, we're seeing a major slowdown hit the U.S. economy. Meanwhile, these political elites are doing nothing to stop it. Plus, we have a sponsor for today's show, Plant Fuel Life. You can find them on the OTC under the symbol PLFLF and on the CSE under the symbol Fuel. They're a plant-based supplement company backed by some major celebrities and athletes, including Super Bowl winning Rob Gronkowski. And we think that this stock could win a championship for your portfolio. We're going to show you a setup for a 2 to 3 time return. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's go to Bloomberg, where we picked this story up and find out more about this leaked report. As the world economy has growing chance of a soft landing, this according to the G20, who seems to believe that we are not indeed headed into a recession, which is hard to believe because we can look around the world and we see just one country after another slowly slide down a path of contraction. We know they're headed into a recession. We know the banks around the world are largely insolvent and facing further crises on their own, and yet these political elites just stand back and do nothing. And we note that the likelihood of a soft landing in the global economy has increased. The question is, where is the evidence of this? According to a draft released just earlier this week, risks to the global economic outlook are now more balanced. Upside risk include faster than expected disinflation. Now, of course, as a consumer, that's what we would love to hear, is faster than expected disinflation, because that means price growth is going to slow at a quicker pace, and that means our wages are going to go further, thus then magnifying the potential chance of indeed a soft landing. But that's not the problem, because what we know is where inflation goes, the labor market will soon follow. And here we can see, of course, the evidence that inflation is indeed coming down as we look toward the energy market. And we can note a very strong relationship between U.S. regular oil formations gas price in red against the consumer price index in blue. And we can see a continued downward trend in energy prices, among other things we'll look at later in the show, suggesting indeed demand is coming down. The problem is, these political elites believe that they have achieved the impossible, and yet they're not doing the one most important thing they could do right now. We'll talk about that in a moment. As the statement reflects a relatively upbeat view of the global economy that struggled in recent years to overcome the impact of the pandemic, soaring inflation, and sharp increases in interest rates. Of course, we know that the sharp increase in interest rates could be an issue that's easily dealt with. Central bankers could start cutting rates back, uninvert the yield curves, but no chance that they're going to do that at all. Inflation has receded in most economies, and I love this, thanks in large part to appropriate monetary policies, because there's two ways you can deal with inflation. You can either increase supply, which makes it easier, give people more opportunities to work and create and produce, or you can constrict demand by inverting the yield and money curves and then constricting the supply of credit and the creation of money in a debt-based economy. One does lead to that mythical soft landing, the other into a globally synchronized recession. And of course, they also cite the easing of supply chain bottlenecks and moderating of commodity prices. But the reality of the situation here is, again, when you constrict the creation of credit, you actually bring demand down significantly at a time when supply was going to go back up anyways following the pandemic. Here we can see the evidence of that as we look at the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes against the consumer price index in red. That's shown on a year-over-year rate of change. And we can see that any time the banks are constricting credit creation, that is when the blue line is above that horizontal black line, we can see inflation continue to rise just due to the money in the system. But what happens over time Eventually, that lack of money to support the growth of the economy and existing debt leads to a decline in demand and ultimately a big decline in inflation, which we note is likely to head further lower here. But Yellen cites monetary tightening as a risk to global outlook, suggesting the question now is, why aren't these central elites cutting rates? This would be the obvious solution here, that if indeed disinflation was the risk to the economy, as this leaked report suggests, then the obvious answer would be that central bankers have rates too high for too long and they need to cut them a little bit, at least. And even though she highlighted in her remarks Tuesday that the strength of the U.S. economy has been the key driver for global economic resilience, and of course we know that the reality of that story was backed by massive pandemic borrowing, giving money out to consumers in a big way and taxpayers to spend, and then followed that up by the fourth quarter where we see a huge surge in credit card usage and buy now, pay later loans. That's really what's fueled the economy. And she notes that over the past year, global growth has been resilient and stronger than predicted. Again, all of this has to do with all that money pumped into the system. America's path to a soft landing has underpinned global growth. And that is actually true because we are the world's largest importer. And that means our consumption fuels the factories around the world. But for how much longer? Well, based on the data we got today, doesn't look like that's going to last either. But Yellen touted the Biden administration policies that she argues have helped drive a surprisingly resilient U.S. economy, suggesting Bidenomics was the hero here, which has featured historically low unemployment. That not to last much longer either. And by contrast, the Eurozone has seen stagnant growth. Japan has contracted, and China has to roll out support measures to counter weak domestic demand. And again, you look back, and a lot of this has to do with the amount of money we put in the hands of consumers, and it piled up in bank accounts, and it just took a long time to spend. On top of that, we suspended debt service and other bills, and that allowed for consumption. You tack on the work from home movement that happened during the pandemic. Well, that released that cost of commuting to work and going to an office, and that went into the discretionary side of the economy as well. So you had a really perfect storm of consumption here to drive the global economy. That's not going to last much longer. And here we can see the consumer price index back in blue now on a year-on-year rate of change. It's an indicator of demand, and demand, of course, leads to labor. Here we see continued claims in red. And what do we know? That as we head into recessions, we typically start to see a pickup in unemployment claims, and then people staying on unemployment as there's a lack of new jobs. But what happens as more and more people have their incomes cut from being on the system, well, demand comes down. And as we move forward out of the 80s, we find it starts to sync up here going to the dot-com bubble as, of course, continued claims lead to an immediate decline in demand. And if it wasn't for that big oil price spike going back in the global financial crisis, we can see again continued claims starting to tick higher. There goes inflation. We're seeing that now. And as we look forward to the data on Thursday, what we expect to see is a steady increase over time in continued claims because their lack of consumption leads to the losses of other people's jobs. And had a recession come in 2023 like many predicted, the global growth would have been thrown off track. Well, that would be true. And Yellen cited policies championed by the administration, including increased infrastructure spending, measures to boost manufacturing jobs, and investments in clean energy is helping underpin U.S. resilience, suggesting that our success has much to do with President Joe Biden. I'll let you be the determining factor on that. You can weigh in the comments because here you can see it's very obvious. We have this leaked report that says everything's fine, but we know we're headed into a recession. We know that for a fact. And if everything is so good, then the simple answer here is cut rates a little bit. There's no reason for central bankers to keep rates elevated because what starts to happen is a slowdown. It begins it slowly at first, and then it picks up steam. And as we look to what's going on with U.S. consumers all of a sudden, well, it looks like things are changing in a big way. Here we see the U.S. consumer confidence retreated in February, down now from a revised 110.9 in January, as February's decline in the index now has dropped to 106.7. It has occurred after 3 consecutive months of gains. So you look at this, the consumers, their confidence was building into last year. They went out and spent a bunch of money. They bought into the narrative that we were going to see this soft landing or maybe even a no landing scenario. And now all of a sudden that's starting to change, and for good reason. In fact, they even note that January was revised downward from preliminary reading of 114.8, and that there was not a material breakout to the upside in confidence at the start of the year, which is what we were told was supposed to happen. In fact, February's writing responses revealed that while overall inflation remained a main preoccupation for consumers, they are now a bit less concerned about food and gas prices, suggesting that those are moderating now, as we've noted, but they are more concerned about the labor market situation and the U.S. political environment. Obviously, elections are coming later this year, but it's the labor market. And I said this would eventually start to show up. The political elites told us, no way. The labor market here is strong and resilient. And I said, look, if you bring demand down, well, that means you need fewer workers, and starting to see that show up in the data here as assessments of the present situation weakened in February as consumers' view of both business conditions and the employment situation became less favorable. Furthermore, consumers' assessments of their personal financial situation also weakened. So here you see the case. People are starting to worry about their jobs. They're starting to see that their hours worked are getting cut, which we'll get an update on that here in another week. So all of this stuff is very critical to what is coming, and that means people's finances start to become an issue. And when people start thinking about their money going the wrong direction, well, their spending drops too. But Zero Hedge notes something kind of peculiar here, that we see the Conference Board revises consumer confidence data significantly lower. In fact, January was the biggest downward revision since February 2022, making this the 4th straight month of downward revisions. Leading the question is, how do you revise consumer confidence down? Do you ask them again? Well, it seems kind of silly, but nevertheless here, the reality of the situation is consumers are less confident. When they're less confident, they spend less, and that backs what we're now seeing from companies here in the U.S. As low sales suffer as home improvement slowdown persists, this being a problem, every little slowdown leads to a few job losses, and then it starts to intensify as inflation and a stagnant housing market had made DIY customers hesitant to spend on big ticket purchases for their homes. So you think about what we just saw from the Conference Board, and it makes perfect sense. If you're worried about your job, if you're worried about the labor market, and you're starting to worry about your finances, what you don't do is go out and make big ticket purchases such as automobiles and durable goods and appliances, because you wonder if you're going to be able to afford it. That starts to impact, of course, businesses like Lowe's, and those that did engage in home improvement activities took on smaller. This is exactly what you would expect, non-discretionary products with a heightened focus on value, suggesting that consumers are only now looking to spend money on things they need to, and that they're not looking to spend big. That is a sign that the economy is changing here, validated by the Conference Board. And that all comes back to, of course, new business orders, as we see U.S. business equipment orders now barely rise as firms rethink plans. So if we look about this no landing scenario that we see in that G20 report that got leaked, that this is not what we're seeing in the actual data. Now, we could look around the world and say, okay, it was obvious China's economy was hurting. It's obvious Germany's economy is struggling, but no one thought the U.S. And here we see consumer confidence coming down. We see companies like Lowe's saying, look, demand is going down, and that all turns into a decline in new orders. And here we see the value of core capital goods orders, a proxy for investment in equipment that excludes aircraft and military hardware, increased 0.1% last month. But get this, after a downwardly revised 0.6 drop in December. So what do we continue to see in the data here is here's a great number, and then afterwards, a month later and the month after that, well, it's downwardly revised. And no one's going to look at this. That is a big drop in new orders going back last month, and it's a tiny increase for this month. In fact, bookings for all durable goods items meant to last at least 3 years sank 6.1%, the most since April of 2020. Now remember, we're in the midst of a pandemic then. Everything was shut down as commercial aircraft orders plunged following a near-miss accident involving a Boeing plane. Excluding transportation equipment orders fell 0.3%. So here we see this validation that demand is going down. If we wanted to fix the inflation problem, we should have brought supply up. Instead, we constricted demand. That ultimately leads to an unwinding, not just of our economies outside the U.S., but as you're seeing, the U.S. economy as well. And here you can see we have manufacturers' new orders in blue against the consumer price index, that in red on a year-over-year rate of change. And it's very obvious that the consumer price index is just the end point of demand, because you look at new orders here and you see a decline in them, as we did going in the dot-com bubble, led to eventually decline in inflation. So you see it in the new order book first, eventually you see it on the shelves second. Happened again here in the global financial crisis. You can see it happening as we went into nearly what was a globally synchronized recession between 2014 and 2016. You see the slowdown going into the pandemic, and you see it now. So again, everyone's saying that inflation here is likely the issue, but even the G20 noticed the risk is disinflation. What they're missing is it's disinflation because demand is crashing. That's not good for the labor market at all. And though many businesses are still committed to making long-term investments, soaring borrowing costs and demand concerns, and there's again, key words, demand concerns, are leading many firms to dial back expansion plans early in the year. This suggests that factory production may struggle to sustainably rebound in the coming months. And if that happens, if we do not see a rebound in the factory sector, well, that means the labor market is indeed the next to go. Made the case of why we're looking at a matter of months before we see this unwind. And now you see manufacturers' new orders, again, on a year-on-year rate of change against continued unemployment claims, because as demand goes down and those order books start to head lower, what happens? People hit the unemployment line because you don't need workers to make the products, ship the products, sell the warehouse the products, or even ship or sell them into the end consumer. And you see that relationship over and over. Demand has been going down, continued claims rising, suggesting that indeed we are facing here the devastating plan of these political elites to crash the global economy, because if they wanted to stop it, they do one simple thing right now, and that is lower interest rates quickly. They don't have to go far. Just get these curves uninverted, get the banks lending again, and keep the momentum there. But something we see that has a lot of momentum behind it, that is a sponsor for our show today, Plant Fuel Life. Again, you can find them on the OTC under symbol PLFLF and on the CSE under the symbol fuel. We're going to show you a chart setup that could generate a 2 to 3x return. This is a superstar of a company. Let's take a look at what's going on with them. We got links to everything in the description and pinned comment below for you. And you can see they're solving the plant-based performance question by taking way out and putting plants in. And they're doing this by their marketing approach through social media, using influencers, sponsored athletes, events. And then they're getting people to try the product at those events and store demos, because they are backed, as I said, by a big number of major celebrities and athletes. And that is going to help push Plant Fuel Life into the forefront of every household, and you're going to want to be an investor. We're showing you an early opportunity to send their stock higher, and then of course that drives memberships and subscriptions. And this behind this is a huge social media blitz. They've got 5 large influencers posting once a month. They've got 10 influencers posting every 2 weeks, and emerging influencers every 2 weeks. They've got major A-list celebrities. This is going to be huge. They're looking at 405 posts, or 45 per month, reaching 20 million people. In fact, my friends, even I've decided to order some of this product. I saw what it was. I did my research, and I can't wait to try it. So I'll have mine here this weekend, and I'm looking forward to trying it, because here you can see even Gronkowski again, remember, Rob, he is a Super Bowl winning champion. He is behind this in a big way. There's going to be commercials featuring him and his family. And here you can see they've got best-in-class formulations. Their supplements are crafted with premium ingredients utilizing the latest breakthrough in ingredient technology. They're all natural, clinically proven, and they are third-party tested. And you can get them just about anywhere. Amazon, Walmart, Whole Foods, Kroger, Target, and Costco. Not to mention, you can even get them online as well. And so, as you can see, this company is going to take the market by storm as they look to eliminate, of course, the notion that you have to use whey in your products. Well, that's their whole tagline. No effing way. So let's take a look here as we see on their stock. People might say there's no way this thing is going higher. Well, it is. You can see the chart set up here as we look in the supply zone down here. Stock is trading around 4 cents. And you can see when it gets into this zone down here, what happens is buyers come in. The last time it traded down in the zone, it shot up to about 18 cents a share. That is a massive return. We can see moving up into the prior supply zone gets you somewhere around a 12 to 14 cent price target. There is an easy look at a 2 to 3x return for our sponsor, Plant Fuel Life. Again, on the OTC, under symbol PLFLF, and on the CSE, under symbol Fuel. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.